orange arrow on the right side of your screen will toggle the control tray open or closed. And at the bottom of that control tray, you'll see a chat window. Definitely feel free to submit your questions at any time throughout the webinar via the chat function, and we'll get to the questions at the end of the webinar as time permits. Additionally, on your GoToWebinar console, you should see an area for audio settings. If you're calling in through your telephone, please choose the Use Telephone option, and alternatively, if you're using your computer speakers, please select the Use Mic and Speakers option. Lastly, I do want to note that today's webinar is being recorded. We'll send out a copy of the slide deck as well as a link to the on-demand recording of the webinar within 48 hours, so definitely keep an eye out for that email if you're interested in accessing the webinar after today. And a few reminders for CE. To qualify for California CE, you must be using a personal computer and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. And lastly, complete the evaluation survey at the end of the webinar. So definitely keep all of those in mind if you're interested in getting CE for today's webinar. And with that, I'd like to introduce today's featured webinar speakers. We have Matt Peralt, who is the partner leading Armanino's SEC and technology audit practice. Matt has supported more than 50 technology sector transactions. With over 20 years of experience and industry experience as a controller and VP finance, Matt is a recognized subject matter expert and frequently consults in the areas of revenue recognition, business combinations, and equity accounting. We also have David Miller with us today. With over 25 years of experience, David is the director for Armanino's outsourced finance and accounting practice. He works with emerging and growing businesses in the franchise, entertainment, technology, and nonprofit industries. Prior to joining the firm, David was the founder and principal of JDJ Business Consulting that specialized in CFO services, project management, and business analytics development. It's great to have you both with us today, and with that, we'll move along to our learning objectives for the day. So during today's webinar, participants will analyze the impact of recently issued accounting standard updates, or ASUs as they're more commonly known, on private and public companies. We will review the background, highlights, and application of recent ASUs, and identify when companies need to adopt and apply each of the new standards. And with that, I'll hand it over to you, Matt.
Thank you. So this slide really just covers what we're going to be talking about today. I'm not going to read through all of them, but obviously we're talking about the accounting standard updates that have now been issued in final form and have varying effective dates. And then at the end of the presentation, time permitting, we're going to talk about some items that are currently on the FASB agenda, and that we'll just talk about those. So let's jump to the next slide. So kick it off with accounting for measurement period adjustments in a business combination. And for those of you that aren't familiar with the measurement period, this is the period following the acquisition of a business in which you, the preparer of the financial statements, have some time to adjust amounts that were put in there on a provisional basis. And the final ASU covering this was issued in September, so hot off the presses. Let's jump to the next slide. So the main provisions here are that an acquirer of a business is now, under this new standard, responsible for making any adjustments to provisional amounts on an ongoing basis. So it's going to be a current period charge to your P&L, and you will see that as a separate line item that you need to record in your P&L, either there on the face of your statement of operations or in a disclosure to the footnote, and you will be making these adjustments as though the correction to the provisional amounts is being recorded in the current period. Now if we flip to the next slide, well, this is just repeating the same one. Sorry, one more slide. Under existing GAAP, you would take those provisional amounts and you would retrospectively go back and adjust the amount. So an example there would be is if the company had acquired a business and that business had ongoing litigation. and then that litigation got settled within the measurement period. If that occurred, then under the existing GAAP, you go back in, open up the balance sheet as of the acquisition date, reallocate the amounts that you recorded, either whether it be an asset or a liability, and then the P&L, as it rolls forward, all of those prior periods you would restate to reflect the adjustment to those provisional amounts. And so you can imagine, as a preparer of financial statements, it was kind of messy when you had to go in and, for the period of measurement for that year following the acquisition, or 12 months, you would continually look at these things and re-update those. And part of it also was that the guidance was inconsistent with the general framework that came out with business combinations, which said, and really dictates rules, that on an ongoing basis, any adjustments that you make to amounts as of the acquisition date are done on a prospective basis. And so this is effective for public companies. It's going to be effective for 2016, and then for private companies, it's going to be effective 2017. You are allowed to adopt this on a accelerated basis, and so you can immediately record these as adjustments to, on an ongoing basis.
And with that, we will launch our first polling question. So you should see it up on your screen here just in one moment. And our first polling question is, what is the typical measurement period following a business combination? Is it 12 months, 18 months, or as long as the company needs, or you're unsure as well? So we'll give everyone a few moments here to get their answers in. Looks like we're almost, actually a little bit over halfway, so we're just getting there. So I think that we'll go ahead and close the poll in just a few seconds here, and I'll give you a little bit of a countdown so everybody can get their final votes in. We're still getting a few. And we'll go ahead and close the poll in 3, 2, and 1. And then I'll pass it back to Matt to talk about the results.
So the largest answer we got here, 71% voted for 12 months, and that is the correct amount of time. Under the existing literature, you're allowed that period of 1 year following the acquisition of the business to make adjustments to those provisional amounts. And again, the most common areas that you're going to see recording adjustments to are for liabilities that relate to litigation that is not settled as of the time of the business combination. The interesting thing is, as you read through the this ASU, the other example they provide in terms of a provisional amount is an appraisal of assets that the acquirer did not have time to complete until some point after the acquisition. In my experience, I've never seen a circumstance where an appraisal was a holdup and that was actually a provisional amount recorded as part of the purchase price. So again, more commonly you're going to see litigation, and another good example would be a collection of a receivable that was open as of the balance sheet date. The ultimate collectability of that receivable could be determined after the acquisition date, and then the same framework where now, again, you don't have to go back in and unwind all of your purchase accounting and the resulting adjustments to the P&L that would happen. So you just deal with this on a prospective basis, either on the face of the P&L or in the
Great. Thanks, Matt. So I'm going to talk about the next accounting standards update, and this is David for everyone. I'm going to talk about revenue recognition and really the deferral of the effective date. So the objective, and next slide, thank you. The objective of this is really to address the challenges identified by the Transition Resource Group for revenue recognition, and really getting the revenue standard established in certain areas. The focus has really been on, and the decisions were really around identifying performance obligations and licenses. There's still some proposed pieces which, at time permitting, we'll talk about later, around the narrow scope improvements, the practical expedience, and then also principal versus agent. So just as a refresher for everyone, around the performance obligations, there are some key decisions and key elements of that to focus on, really 5. One is promised goods and services, which the current decision is not required to identify goods or services promised to the customer that are immaterial in the contract with the customer. 2 is separately identifiable or distinct within the context of the contract, and that was the board had affirmed the previous decisions made in that area. Shipping, the next one is shipping and handling activities. Again, the board affirmed how shipping and handling would be treated, so any shipping and handling before the customer obtains control of related goods are deemed to be fulfillment activities and therefore would be classified as such on the P&L. And it was also confirmed that you will accrue any shipping and handling at the time the revenue is recognized, even if those shipping and handling activities have not occurred. The 4th part of that is the series provision, which is still a requirement. At one point it was considered optional, but now it is required. And then the disclosure of the transaction price, and really no amendments to the disclosure of the transaction price. And then on licenses, the board really affirmed that an entity's promise to transfer a license to functional intellectual property, that's really intellectual property that has stands up by itself, really, for so the ability to process a particular transaction, perform a function or task, or performed or played on the air for intellectual property like music. That's a separate performance obligation, and it's satisfied at the point in the time that the license is granted, unless there's a couple criteria that are met. And really those 2 criteria are around the customer has rights and expected to substantially change during the license period as all the activities, and the customer is contractually or practically required to use the updated intellectual property criterion. So that's a little bit of a refresher. So really the big change here is really the effective dates. Next slide, please. Is really the effective dates. So the effective date is really getting deferred by 1 year. So for public entities and some not-for-profit entities and some employee benefit plans, they will apply these decisions to annual reporting periods beginning after December 15th, 2017. That would include any interim reporting periods within that reporting period. You can go back and apply it earlier, only as of annual reporting periods beginning after December 15, 2016, and then that would include any interim reporting periods within that reporting period. So you can go back.
Yeah, and for those of you that have been following, the AICPA has created separate task forces. I believe right now there are 14 different industry task forces that are working on implementation guidance, and those will be released. They will be non-authoritative, but certainly I imagine anybody that is practicing in any one of those industries is going to want to get a copy of those ultimate guides that are released, because although non-authoritative, I think by default they will become the practice that everybody's following. And that's really the reason that the FASB delayed this requirement or the adoption of this standard for another year, just to give both the AICPA and the FASB is still working through some comments, and so they're going to be issuing, and David I think is going to cover this one later, but more ASUs before this came out. So just keep your eye on those.
Yes, and to Matt's point, there's definitely get the industry information, because there are, as you can see here on the additional effective dates, certain industries will be affected within certain periods. So encourage you to get that information. But really here, This really talks about other entities besides the ones we've already discussed. They'll apply these changes in confirmations in the annual reporting periods beginning after December 15, 2018. And again, any interim reporting periods within the annual reporting periods beginning after December 15, 2019. Also, and we can read through some of these other guidance, but the best thing to do is going to be to get some of that specific industry information. Let's go to the next slide. So for public business entities and certain not-for-profit entities, and then certain employee benefit plans, the effective date, again, is going to be for the annual reporting periods beginning after December 15, 2016. And it will include the interim periods within that reporting period. And then the effective date for all other entities was for the annual reporting periods beginning after December 15, 2017, and interim reporting periods within the annual periods beginning after December 15, 2018. Okay, so let's move on to inventory. So this is really about simplifying the subsequent measurement of inventory, and really the project objective here is really to reduce the cost and complexity of the subsequent measurement of inventory, really while maintaining or improving the usefulness of information required around the inventory. So next, thank you. It does not apply. So who's affected in this? So it doesn't apply to inventory that is measured using last in, first out, or the retail inventory method. It does apply to all other inventory, which includes inventory that is measured using FIFO or average cost. Now the board decided to limit the scope of the simplification to exclude inventory measured using LIFO or the retail inventory method. And here, an entity should measure the inventory at the lower cost of and net realizable value. The net realizable value is the estimated selling price in the ordinary course of business, less any reasonably predicted cost of completion, disposal, or transportation. No real change there. And then the subsequent measurement is unchanged for inventory measured using LIFO or the retail inventory method. And then we're going to align the measurement of the inventory in GAAP with the measurement of inventory in international financial reporting standards. So really trying to get bringing those two closer together, the GAAP and the IFRS.
David, have you seen in practice a change in the way folks are viewing inventory in this new standard? I know certainly in the technology arena, I think it's not having a substantial impact on my clients and the way that they value inventory.
No, I haven't seen for the clients that I've been working with, I really haven't seen any significant changes on their inventory. I think it's just really a refinement and of practices that I think really the practice that really makes sense.
Okay. So
the effective date for this is really the public business entities are affected for the fiscal years beginning after December 15, 2016, and includes the interim periods within those fiscal years. All other entities are effective for fiscal years beginning at December 15, 2016, and interim periods within those fiscal years beginning after December 15, 2017. And then we're going to apply it prospectively with the earlier application permitted as of the annual beginning of an interim or annual reporting period.
And now we'll move on to our second polling question, which will appear on your screen here just in a moment. So our second question will be, ASU 2015-11 affects which inventory measurement methods? LIFO, last in, first out, retail inventory method, FIFO, first in, first out, or both A and B, or both A and C? So we'll give everyone a few more moments here to get started. And just a reminder, this is our second question. So you would have seen one earlier, and then we'll have two more after this one. So just about 75% of everyone has voted and submitted their answers so far. So we'll give everyone a few more moments here so that we can let everyone participate. And just a reminder, you do need to participate in at least 75% of the polling questions in order to qualify for California CE. So we'll go ahead and close the poll in just about 3, 2, and 1. And then I'll pass it back to you, David, to cover the answers.
Okay, so the answer, and shown by 51% of the group, is the first in, first out method. So as you mentioned, really no changes in LIFO and no changes in the retail inventory method. It's really focused on bringing some of those costs against the first in, first out inventory method.
All right, let's jump into ASU 2015-08. Next slide, please. So as you may recall, back at the end of 2014, the SEC eliminated its guidance on push-down accounting. And for those of you that aren't familiar with push-down accounting, push-down is a circumstance when entity A goes out and acquires entity B. And now the question is, for that acquired entity, do you apply purchase accounting so that you fair value all of the assets and liabilities of that acquired entity as of the acquisition date, taking into account the purchase consideration? So again, the SEC had pulled down their guidance on this in 2014, and now effectively the FASB was just updating their codification to remove this guidance. And what this does, for those of you that maybe didn't catch this at the tail end of 2014, under the old SEC guidance, SEC rules had established 3 levels of ownership under which push-down accounting was either mandated, optional, or not permitted. So if you owned greater than or acquired greater than 95% of an entity, then that entity was required to apply push-down accounting to its books and records. If you, the acquirer, held somewhere between 80 to 90, or there was a change in control of 80 to 95%, then it was optional whether or not to apply push-down accounting to that subsidiary. And if the change in control was less than 80%, then push-down accounting would not be applied to that subsidiary's individual books and records. And one of the reasons that the SEC eliminated this and the FASB in concert eliminated it was because there was no guidance in FASB codification that said when to apply push-down accounting. And so oftentimes private companies were left deciding what to do, and they would look to the SEC guidance and just sort of created an inconsistency between public and private company practice in when to apply push-down accounting. And so again, that original pronouncement has put out by the SEC and now as by the FASB. Anything happening after November of 2014, now you have the option or the election to create an accounting policy which will dictate whether or not you are going to apply purchase accounting at the subsidiary level. And for many companies that just simply don't want to go through the heartache of applying purchase accounting down to the sub-level, this is a much easier answer. Certainly the requirements for the acquiring entity remain the same, and on the acquirer's books you still have to do all of the necessary accounting to reflect the acquisition and refair value everything as of the purchase date.
And now we'll move on to our number 3 polling question. So we've got it up on your screen here in just one moment. Sorry, we've got a bit of a delay, so it'll take a second there. So ASU 2015-08 represents a significant change in practice for which of the following? Private companies, public companies, both public and private companies, neither public nor private companies, or you're just not sure. So we've got about half of you have voted so far, so we'll give everyone a few more moments here. We're getting some great responses on the poll, so thank you everyone for participating in those today. We always appreciate an interactive audience. So we're just about through, so we'll give everyone just a few more seconds because we are still getting in some answers. I know a few people were having some issues getting their answers in, but we will go ahead and close the poll in 3, 2, and 1, and then I will pass it back to you, Matt, to discuss the answers.
Thank you. So yeah, again, the way that the FASB worked, they're just eliminating this from their codification. I don't know why it would have taken them almost a year to strike off of their codification something that the SEC rescinded. But the most common answer here was that this affected both public and private companies. And although this amendment struck it from the ASC code, it really didn't affect public or private companies because both entities were already affected by that change that was issued in 2014. Turn it back over to David.
Thanks, Matt. So we're now going to focus on the customer's accounting for fees in a cloud computing arrangement. Next slide, please. So here, really the project objective here was really to provide some guidance to customers about cloud computing, whether a cloud computing arrangement includes a software license. Now, as you know, software as a service and cloud computing is becoming more and more important part, not only of in the accounting space as it is emerging, but it's also part and parcel of other software companies who are building other applications and acquiring or licensing a cloud software to be able to complete their software. So it's very much a cross-pollination of transactions. So if a cloud computing arrangement includes a software license, then the customer would account for the software license element of the arrangement consistent with the acquisition of the other software license. If a cloud computing arrangement does not include a software license, then you would really treat it as an arrangement as a service contract, so really as an expense. In a situation where you are treating it as a software license, you then may have a subsequent royalty obligation that accompanies that and would have to treat it as such. Next slide, please. So the main provisions of this update is really to provide guidance to customers about whether it includes the software license, which we mentioned. Really, we've talked a little bit about this. So let's go to the next slide. Now, let's talk about where it is effective. So this is effective against public business entities and would be effective for annual periods, including interim periods within those annual periods beginning after December 15, 2015. All the other entities be effective for annual reporting periods beginning after December 15, 2015. So this is an imminent change ahead. And it would affect interim periods in the annual periods after December 15th, 2016. So there's no problem taking on an early adoption of this and adjusting the treatment. And an entity would then either elect to, going forward, address all arrangements entered into or materially modified after the effective date, or you could also go back on any financial statements that you are presenting where this would have an impact.
David, do you understand why this, the FASB, again, I'm looking at my client base of technology companies that license applications to build out or enhance their applications. In the majority of those circumstances, they're paying a monthly fee arrangement, and therefore this thing is, typically what they're paying is just expense. Do you see this is going to lead to a change in practice where companies would be putting more amounts on their balance sheet? Is it the nature of arrangements that you've seen?
Well, I think that the challenge here is really going to be on the provider. There's a couple challenges. One is you have to actually be able to differentiate in your pricing model. So on the outbound part of this, so it's really potentially impacting the licensors of some of this software, right? And being able to differentiate, let's say, what would be capitalized versus what would be whether or not it's a service contract. So in that determination, and then on the other side, so to answer your question, I haven't really seen this really yet become an issue with companies, but even you have to be able to then to differentiate on the purchasing side. You have to be able to differentiate how you're actually using the software, right? So great example. An example of where it's typically a service contract is sort of some of these cloud service accounting arrangements, right? So with Impact or Xero or QuickBooks Online, our approach with all our clients is to really treat that as a service approach. We're not taking that accounting software and then building another accounting software. And if we were doing something like that, then we'd have to talk to those providers about splitting that pricing and being able to capitalize some of that, or breaking it up to be able to establish some sort of how that would be capitalized and then amortized over the life of the project. So it's really, I think, it's really in those software to software businesses. I think for the majority of the companies that are out there right now, it's not going to create a lot of impact in the early days.
Right. Seems in practice as well, most companies are sort of applying different standards. We do sort of an annual survey on the capitalization practices of both software companies and then software as a service companies, and it seems companies really take it, and in those circumstances, right, the gap is pretty clearly laid out, but even in those circumstances, I think companies are taking some liberties in terms of who wants to capitalize what dollar amounts. So I imagine in practice this pronouncement is not going to change significantly what folks are doing.
I would agree. Let's go to the next slide. So as we apply this, as we go forward then, so for the prospective transition, only the disclosure requirements of the transition would really be the nature and the reason for the change in the accounting principle, the transition method, and a qualitative description of the financial statement line items affected by the change. So going forward, really it's a disclosure requirement, and which would include obviously the reason for the change and what sort of method was adopted. For the retrospective transition, disclosure requirements of transition will include the requirements for both the prospective transition and the quantitative information about the effects of the accounting change. So here it's just really saying, whatever the quantitative impact is of making that change on your P&L and or your balance sheet, you really want to capture that as part of the retrospective transition. Prospectively, just need to disclose it.
Yeah, I got to imagine not many companies are interested in recasting their comparative periods to try and deal with the standard on a retrospective basis. So certainly I think any change we see is going to be on a prospective basis.
Yep.
All right, so let's jump in next to consolidation, talking about principal versus agent analysis, ASU 2015-2. And for those of you that are practicing in whether it be real estate industry where you've got a general partner and a limited partner, or maybe venture capital, for those of you that recall, the original standard, FIN 46, that came out several years ago, was aimed at making reporting entities take a look at the companies and entities that they had affiliate relationships with. And again, a good example here would be a real estate developer that is responsible for managing a project. They take that project and they put it into the form of a limited partnership. The real estate company itself is a general partner, and so they're directing the business activities of that LP. They typically have some degree of ownership interest in that LP, but more commonly the relationship is based on a fee structure where they're getting a fee for managing that project or that business, and similar to in the venture capital community, the venture capital partnership is set up as a general partner, and then each of the funds are set up as limited partners. And so when the original variable interest entity guidance came along, these things were originally included in the scope based on the way the guidance was written, and over the years the FASB has sort of kept kicking the can down the road, if you will, and even more recently when they adopted FAS 167, which replaced FIN 46, they said we're going to defer the adoption or the application of this to entities that have a GP-LP relationship. And so what this standard finally does is it says we are now going to require consideration of consolidation for these entities that had otherwise been deferred under the deferral of FAS 167 for these sort of investment companies. And so the first question you have to ask when you're evaluating a variable interest is the entity being evaluated, is it a variable interest entity? And again, there was under the existing GAAP different requirements for performing that consolidation analysis, and you see here it could either be an indefinite deferral, an entity that's within the scope of 167, and then an LP that has a voting interest in an entity, and depending on where you fell in this first three criteria, then you would have different requirements for performing a consolidation analysis. Now, all entities have to consider consolidating all of their related entities. And under old FAS 167, if you were receiving fees, that could represent a variable interest entity, and you, the GP, had to take a look at whether or not you met 6 different criteria in order for those fees to not be considered a variable interest. So now under this new ASU, there are only 3 criteria that you have to look at in terms of the fees that you receive to evaluate whether or not this is a variable interest entity. The first is determining whether or not the fees are compensation for services that are commensurate with the level of effort that you are putting forth. So again, in the example of a venture capital firm, if the typical relationship or fee structure is 1% of assets under management, and that's common in your industry practice, then you would say the nature of the relationship with that LP does not create a variable interest entity. The second is taking a look at the service agreement, making sure that whatever you're doing for that entity is typically something that you would be doing if you negotiated at arm's length transactions. And then finally, you've got to make sure, and this is really in alignment with FAS 167, that you do not have an obligation to either absorb losses in that entity or that you have an opportunity to receive returns in that. And so any of those circumstances really could create a variable interest entity, and then you have to step through the next step in taking a look at whether or not you are the primary beneficiary and consider that for consolidation. So again, under this new model, it's really taking a look at reducing the number of circumstances, the sort of decision tree paths that you have to walk through in considering consolidation, and focusing you on whether or not you've got a risk of loss in controlling the financial interest of that entity that you have a relationship with. And so for public companies, this is going to be effective for 2016, and then private in 2017. Early adoption is permitted even on an interim basis, and this will be you can elect to do this on a modified retrospective approach. So if you find an entity that you would need to consolidate, you can do that on a comparative historical basis. And so I think it'll be interesting to see these entities that have a significant relationship with LPs, whether or not consolidation is going to happen in the upcoming years. All right, David, turn it back to you.
All right, thank you. So we're going to talk about eliminating the concept of extraordinary items, which in and of itself seems like an extraordinary event. So I think this is good news. So really it's reducing the cost and complexity of the income statement preparation by getting rid of or eliminating the concept of extraordinary items, while at the same time trying to maintain or improve the information provided to the users of the financial statements. Now, I'm sure everybody knows and understands why we had the extraordinary items. I mean, really, this is something that's come up over and over again with a number of various extraordinary items that's happened, particularly over the last 15 years. Don't need to go into those details, but really the FASB's emerging task force really wanted to understand the impact of this and really took a really close look at this and really decided to shift how this is reported, this concept. So let's go to the next slide, please. I want to understand a little bit more. So eliminating this is really going to save time, and the approach is really to eliminate the extraordinary item and save time and reduce the cost for preparers, because now they don't have to assess what a particular event or transaction event is extraordinary, right? So there was a number of criteria that we would use to do that. Extraordinary, unusual, usually would apply to things like abandonment of properties or the loss of an entity. So now we're really just trying to align more closely the GAAP income statement presentation, which prohibits the presentation and disclosure of extraordinary items. And this also affects then the calculations of earnings per share, the number of other things in the financial statements that take extra time. So it's really, I think, really streamlining this process. Let's go to the next slide. So that said, though, if an event or transaction does meet the criteria for extraordinary classification, entity is required to segregate the extraordinary item from the results of ordinary operations and show the item separately, income statement net of tax after income from continuing operations. The entity is required to disclose the applicable income taxes and either present or disclose earnings per share data applicable to the extraordinary item. So you still need to disclose this information. Let's go down to the next slide. So this would be applied prospectively for extraordinary items in annual periods and interim periods, with those annual periods beginning after December 15, 2015. You can take this on earlier. At the transition, an entity would be required only to disclose, if applicable, that an item included in income from continuing operations after adoption relates to an adjustment of an item previously separated, classified, and presented as an extraordinary item before that date of adoption.
All right, so this one's just a quick reminder of an ASU that came out in 2010, pro forma information under a business combination. Again, sort of at the tail end of 2010, this information came out, and there are different requirements for the audited financial statements that need to be included, and then in turn the pro forma information that shows that combination on a retrospective basis. So this piece of guidance came out, and the reason we're including it here is a number of our we've seen a number of SEC comments come across the board that pro forma information is being provided for interim periods in the current year, and then whatever corresponding periods the financial statements are included. So if you had to include 2 years of audited financial statements as an exhibit to the 8K filing, then oftentimes registrants were including 2 years of pro forma information. And so again, just a reminder here that you only need to include pro forma financial information on a P&L basis for that one prior year. Back to you, David.
Let's talk about the presentation of debt issuance issuance costs. So let's go to the next slide. So really simply stated, this was issued in April of 2015, so it's been out there for a while. But just as a reminder, because it's been many months. So really the objective here is to really reduce the cost and complexity in the presentation of the debt issuance cost and aligning it with this presentation similar to how we deal with the debt discount premium. Next slide. So really this is, really aligning the debt issuance costs in the same way that we deal with discounts or some of these other elements. So require that the debt issuance costs related to a recognized debt liability be presented in the balance sheet as a deduction from the carrying amount of that debt liability, very similar with debt discounts. The recognition, measurement, and the guidance for debt issuance costs is not affected by the amendments in this update. Next slide. So when is this effective? So this is basically effective for any of the fiscal years beginning after December 15th and interim periods within those years. So this is basically happening now. For all other entities, financial statements issued for fiscal years beginning after December 15, 2015, and interim periods within the fiscal years beginning after December 15, 2016. And then early adoption for financial statements that had not been previously issued. So this is basically going into effect now. And then really importantly, as you're updating your balance sheets for this information, really should apply the guidance, the new guidance on a retrospective basis, and make sure that these disclosures include the nature and the reason for the change in the accounting principle. So let's go to the next question.
Thanks, David. So this will be our fourth and final polling question today, and this one is simple, true or false. So the recognition and measurement guidance for debt issuance costs are not affected by ASU 2015-3. And then, of course, true, false, or not sure. So we've got a good number of folks already voted. I do want to remind everyone we have gotten a few questions. The slides and the on-demand recording of the webinar will be made available to everyone after the webinar is over, so we will definitely send those out, and then they are always available on our website as well. And one other reminder, if you are interested in qualifying for California CE, this is your last chance to participate in one of the polling questions, and you do need to have participated in at least 75% of the polls today in order to qualify. So with that, I will go ahead and close the poll in 3, 2, and 1, and pass it back to you, David.
All right, let's see. We've got 31% as true, 50% as false. So the answer here is true. Really, the only change was the requirement to apply the change retrospectively and apply the change retrospectively to all periods presented in the financial statements. And next.
So now we're going to talk about some proposed standards that are on the FASB's plate at the moment. And the first one is Private Company Council 15-01, and it encompasses these 4 ASUs that have been issued and approved as effective. So who's affected by this? All private companies. Certainly those standards are written for private companies. And there's guidance contained in these 4 ASUs. And now, under this proposed standard, the guidance for those is going to be immediately. And I don't think that really represents a significant change in practice, because if you look at the effective dates of all those, many of those have already passed or are happening here at the end of 2015, and so will be effective for 2016. The most important thing I think to take note of here is that the current requirement when there is an accounting policy option is that you have to elect to adopt new guidance on an immediate basis when it's issued. You can't just sort of decide maybe a year from after the effective date that, oh, we're not going to adopt this new policy without documenting that that is a preferable accounting policy treatment. And so really the gist of this proposed standard is that companies now on an ongoing basis, when there are two or more alternative methods, and these are the four examples that they're citing here specifically, is that the private companies do not need to spend the time, energy, and effort to show why one policy is preferable to another. They can just automatically switch on a prospective basis to any of the allowable methods. Certainly, companies are not going to want to change one time and then change back to another method, but if the company's business practices change so that measuring under one accounting policy makes more sense and more closely aligns with the economics of the business, then the FASB put this out and basically saying when it makes sense for your business, go ahead and adopt it. You don't need to ask your accountants to validate that it's a preferable approach. And again, so this just removes the effective date from the concept of effective date from these four accounting alternatives, and so companies can start doing them immediately, and they don't need to justify why they chose those policies or when they began invoking those policies. So effective immediately. But again, most of those effective dates are already effective under those standards that the four standards that are covered by that.
Okay, so let's we're kind of going back to the future. We had addressed the revenue from contracts in the beginning of the discussion today, so now we're going to focus. There were still two pieces, as I mentioned, that are still in the proposal stage, which is why some of those dates are a little further out. So they're still sort of still addressing customers and some of the narrow scope improvements and the practical expedience. So, so who's affected? So it's any entities with these transactions. It's really entities that enter into contracts with customers to transfer goods and services, and the recognition and measurement of these provisions would affect entities with transactions that are included under the category of other income. So really, next slide, please. Part of the approach for this is really bringing GAAP and IFRS, particularly on the revenue side, and really the driver being the global economy and a lot of our transactions these days, 2/3 of companies' transactions can be international transactions. So even originating out of the same country. So it's really the goal is really to bring these two things together. So the transition date and the effective date would be the same as the effective date for the effective date and the transition. So for the revenue from contracts with customers. So very similar. It'll be the same dates. They're still just working through these things. So next slide, please. So again, really with IRS, the revenue from contracts with customers create common revenue recognition and guidance for GAAP and IFRS, as I mentioned, and the result of the joint project between the FASB and the IASB. This will help reduce the cost and complexity of implementation, enhancing the operability and understandability of the guidance. Next slide, please. It's not going to change the core principle of revenue recognition. It's just going to focus on a few narrow areas. So some of those areas include the collectability criterion, the presentation of taxes collected from the customer, non-cash considerations, contract modifications at transition, completed contracts at transition, technical correction transition guidance, and other developments continue. So the changes are not identical to those proposed by the IASB, and some are actually incremental to the amendments proposed by the IASB. But the FASB expects that this will not result in financial reporting outcomes that are significantly different than those reported under IFRS for similar transactions. Next slide.
All right, so one other thing that's on the FASB's agenda is a relook at financial statement accounting concepts number 8. And for those of you that are familiar with FASB concept statements, that's effectively if there's no authoritative guidance in the literature and you need to determine how to account for something, it's sort of the next level in GAAP hierarchy that you would go look to provide guidance on the transactions. And the FASB standard setters also look to those statement of concepts when they are developing their pronouncements and guidance that comes out. So this particular one is focused on revisiting financial statements and footnotes in particular to make sure that the information in those footnotes is relevant to current and potential investors. And so one of the questions they put forth is, do the financial statements assist folks in making decisions on whether or not to invest in the business? And then are there concepts or things that are in the footnotes that they think should not be in the footnotes? And so if you look, there was, I guess, about 70 different folks that replied to these questions, and then the FASB is now going to take the response to these questions and go back and sort of revisit FASB concept statement number 8, which again would be the overarching guidance that they use when they're developing footnote requirements. And certainly what they're hearing from their constituents is the footnotes have grown over the years to be very cumbersome, and a lot of the information in there is not necessarily relevant to users of financial statements. The biggest emphasis is cash, how much company is the generating, and how much is the company using, and what are the sources and uses of those cash flows. So but I expect the final release of this statement of concepts is going to happen probably not until the next year, and then that will have a trickle-down effect as to how it impacts significant disclosure requirements. So just something to keep your eye on, but I don't think it's going to result in any immediate change in the volume or complexity of footnotes. And again, just another one of the questions they've put forth to the constituents in sort of evaluating whether or not the footnotes have the right amount of information in them.
Okay, so let's talk about the proposed changes on the disclosure, notes of financial statements, and whether or not disclosures are material. So next slide, please. So really the objective here was, and the primary focus of this disclosure framework project is really to improve the effectiveness of the disclosures and the notes in the financial statements. So it's really putting guidelines around clear communication of the information required by generally accepted accounting principles, and make sure that the information that is disclosed is most important to the user of each entity's financial statement. So who is affected by this? The legal concept materiality is not limited in scope by entity type. It would apply to all entities. Next slide, please. So the materiality concept would then be applied to quantitative and qualitative disclosures individually and in the aggregate in the context of the financial statements as a whole. Therefore, some or all or none of the requirements in the disclosure section may be material. It's really relevant to the size and scope of the business entity. But then materiality would be identified as a legal concept. And omitting a disclosure of immaterial information would then not be an accounting error. So the differences where we are today and what the improvements are proposed. So the approach is really to clarify the way materiality is going to be considered when assessing the requirements for providing information that notes in the financial statements. It would not change any specific disclosure requirements. It would, however, be noted that there are currently 4 disclosure framework projects on the board's agenda, and it may change disclosure requirements around compensation, retirement benefits, income taxes, and fair value measurement. And then the other consideration is, or the difference is it would improve the effectiveness of the notes of the financial statements by helping reporting entities omit immaterial information. Next slide. So it would be, so when this does go into effect, it would be effective upon issuance. And again, reporting entities may choose to apply it in the current year or prospectively or retrospectively. Next slide.
Thank you, David. So in just sort of a conclusion wrap-up here, from today's webinar, you would have been able to analyze the impact of recently issued ASUs on private and public companies, review the background and highlights and application of recent ASUs, and we also identified when companies need to adopt and apply each of the new standards. So I know that we do have a number of questions that did come in. Unfortunately, we are out of time today, so we will be able to get to your questions offline. If you do have any specific questions for Matt or David, definitely feel free to reach out to them directly. Their contact info is up on the screen, but as I mentioned earlier, we will be sending out the slides as well as a recording to today's webinar. So as you exit, there will be a quick survey. If you're interested in qualifying for CE, you must complete the survey on your way out of the webinar. So definitely, and even if you're not qualifying for CE, definitely still take a moment to let us know your thoughts on today's webinar. And thank you everyone for your time. Thank you Matt and David for speaking for us, and everyone have a great rest of your day.